On the left, we have Democrats who promise us safety by taking more money from us through taxes. On the right, Republicans promise us more prosperity by taking more money from us through debt. These are two sides of the same coin, offering Americans the illusion of choice. Yet every time it seems we've run out of runway, they pull a magic rabbit out of their hat. Or I should say they pull magic money out of their tree. But how long can this go on? Is it actually possible to continue kicking the can down the road forever? If you haven't heard already, the government is not shutting down. Moments before the deadline, they passed a 45-day stopgap bill. This resulted in Kevin McCarthy being removed from his seat as the Speaker of the House of Representatives, which represents the first time in history a U.S. speaker has ever been removed. So what happened? Well, the prior week, McCarthy presented a bill that got nowhere. Nobody voted for it. There's a fantastic video about this by Clear Value Tax. I recommend going and watching. But essentially, right before the deadline, McCarthy presented another bill that he knew the Democrats would not be able to pass up. He told them it has everything you want, just not the additional funding for Ukraine. So no spending cuts whatsoever. Now, the problem was that the Democrats didn't believe him because they didn't have enough time to actually read the bill before they were supposed to vote on it. Now, as luck would have it, just by sheer coincidence, for the first time this has ever happened, Congressman Bowman, a Democrat, accidentally pulled the fire alarm because he thought it was the door handle. This just happened to give the Democrats just enough time to finish reading most of the bill, and they were able to find out, actually, McCarthy wasn't lying here. He actually gave us everything we wanted, minus the additional funding for Ukraine. This is a stopgap bill for 45 days. However, it did result in McCarthy being ousted as Speaker. But the question arises, is this actually kicking the can down the road? Now, I have a problem with this analogy, kicking the can down the road, because when you think about that analogy, you could actually continue to kick a can down the road. Every time you walk up to the can, you can kick it again. And further than that, there are no consequences. You just continue kicking the can. And so the use of this analogy, I think, is very misleading because it implies, hey, we probably should pick it up and throw it away, but there's really no consequences to just delaying it. And that's actually not the case here. I think a more fitting analogy is kicking a snowball down a mountain. For example, when my wife and I first got married, we were saddled with debt. We had more debt than we had in our entire annual income. Now, because we buckled down and made a few massive changes, we were able to get rid of that debt in 9 months. This is the same process that I teach to members of Heresy Financial University. And if you're interested, there's a link in the description below. But what we could have done at the time is we could have said, hey, there are some credit cards right now offering a 0% introductory rate for a year. We can open up a credit card, do a balance transfer, and reduce our payments. And because our payments are lower, we can now spend even more money with those credit cards so that our payments are back up to exactly what we can afford and spend a lot more money in the meantime. That would have felt great in the moment. We could have gone on massive vacations, spent a lot of money on great restaurants, enjoyed shopping for whatever we wanted, and it would have felt great in the moment. But that's not kicking the can down the road. That's kicking a snowball down a mountain, making the problem much worse in the future. When a snowball is rolling down a mountain, you actually have to run ahead of it, get in front of it, and stop it, which takes effort and work. But the longer you wait to do it, the harder it gets. And if you wait long enough, it may even become unstoppable. Now, this gets to the heart of the argument that I hear from MMTers all the time, that the government cannot default on its debt if it issues debt in its own currency. Well, given the fact that Congress recently averted a government shutdown within just a few hours of deadline, and that US government debt is trading at interest rates that it hasn't been at in over a decade, anyone with a brain knows this just isn't true. They can default. It might be because of political polarization. It might be because of disagreements. It might be because they just can't get their act together, but it has nothing to do with the fact that their debt is denominated in dollars. They can default. The consequences would be so severe that most people believe that they wouldn't choose to do something to stop themselves from defaulting, but it's not an impossibility. Further than that, the federal government doesn't actually issue its own currency. It doesn't actually control the dollar. That's the job of the Federal Reserve. The federal government also doesn't control the interest rates that it pays on its own debt. Again, that is influenced primarily by the Federal Reserve. and also influenced by every market participant. So the government actually can default on its debt. And the higher its debt gets, the more spending it takes on, and the more it borrows at higher and higher rates, the more the market will reflect the chance and the risk of that default. This is why we are seeing a massive sell-off in government bonds. Anybody who has invested in long-term government bonds is currently sitting on a balance sheet that looks like this, with over a 50% loss from its peak in 2020. The 30-year yield is now nearing 5%. The 20-year yield is actually now above 5%, almost identical to the 2-year now, and we are seeing a flattening of the inverted yield curve. This is so severe that we are seeing treasury yields decoupling from data that it usually follows closely, like manufacturing data. It is also moving away from its correlation to the copper-gold ratio. This is being driven by the fact that the government is borrowing more and more, with fewer and fewer lenders out there who have the money to lend. And there's speculation that bond vigilantes are taking advantage of this. And with the Federal Reserve signaling higher for longer, it looks like the market is finally starting to believe them. Here's the reality. Whether you're an individual, an institution, or a nation, if you borrow too much, eventually there are no more lenders. The skyrocketing interest rates on long-term government debt reflect this. And the more the government has to borrow to pay for its absolutely out of control spending, the worse this problem will get. Right now, they have to pay 5% to borrow for the long term. Tomorrow, it might be 6%. What happens when the federal government has to pay 10% or 15% just to attract a lender? And finally, here's the biggest issue with all of this. The national debt is not a national asset. It is not just debt we owe to ourselves. The government borrows from some to pay that money to others. Then it takes money through taxes from some to pay back plus interest to those others. Debt matters because it's a wealth transfer. And since debt and taxes go hand in hand, that's why this political system is broken. They offer you the choice of more debt or more taxes. All a distraction so that people don't pay attention to the wealth that is being transferred away from them. It is not a time for a change in leadership like a new speaker. It is not time for a change in power like a new president. It's a time for less leadership, less power, and less government, resulting in less confiscation of wealth through debt, taxes, and inflation. And that is what would finally stop the snowball from being kicked downhill. And for the absolute best place to learn how to protect your portfolio against out-of-control government spending and other risks like that, you need to join Heresy Financial University. If you're wondering whether it's for you or not, just ask yourself the question: how much money are you losing every single month, every single quarter, and every single year by not knowing how to mitigate the risks of large losses in your portfolio? If that answer is more than $99 per month, less than the cost of Starbucks coffee every day, then the answer is it's for you. Join at the link in the description below. As always, thanks so much for watching. Have a great day.